the story of gold. Now, if you're someone looking to invest in gold without the hassle of physically holding it, sovereign gold bonds are here for you. Now, SGBs or sovereign gold bonds are back once again. This is the first such tranche or issue in the calendar year 2024. Now, SGBs are government securities denominated in grams of gold, and they are substitutes for holding physical gold. Launched today on 12th of February, the Reserve Bank of India has set the issue price at 6,263 rupees per gram of gold, called the Sovereign Gold Bond Scheme 2324 Series 4. The issue will be closed on 16th of February. So it's now open, will be closed on 16th of February. SGBs applied for under the 2324 Series 4 will be issued on 21st of February 2024. The last issue of SGB scheme, which is the Series 3, was launched during December 18 to 22nd. In that time frame, the issue price was set at 6,199 rupees per gram of gold. Now, the sovereign gold bonds have a tenor of 8 years with an option of premature redemption after the 5th year. Interest is paid at a fixed rate of 2.5% per annum and is fully taxable. However, the profits made on redemption are fully tax-free. So should you buy, should you not buy? That's the big question. Joining us is Kunal Shah, Head of Securities, Head of Commodities Research, Nirmal Bang. Kunal, thank you very much for taking time out. Always good to have you on the show. The big question, of course, for all those people looking to buy gold at this point, should they be looking into investing in SGBs?
Yeah, so first question is, should you buy gold at even high rates? We are at 62,000 rupees. So the answer to that is absolutely yes. So irrespective of what kind of returns it has given in last couple of years, still it is a great investment even at these levels. Now coming to the second part, sovereign gold bond, my answer to that is, in India, if you want to invest in paper gold, this is the best option available for anyone who wants to invest in. And I think this is the right time, to invest in SGBs. There are a lot of advantages. There's a lot of benefits what you are getting. We'll touch upon that, but it's definitely one of the best buys.
All right. And yes, Krishna.
The reason why I think we were asking this question to you is that there are many ways of investing in gold these days, and Indians traditionally like buying physical gold if they want to invest in gold. And even when it comes to paper gold, there are so many options. There's gold mutual funds, there's gold ETFs. Amongst all those options, would you still say the SGBs or the sovereign gold bonds are the best form of paper gold to buy in?
And today? If yes, why?
Yeah, if yes, why?
Yeah, so like you said, in all the options, it is the best buy because it gives you the most simple thing is 2.5% interest. There is no AMC, there is no asset management charges in sovereign gold bond. And every year you are going to get 2.5% interest per annum. So this is the USP. So if you are investing with a lock-in period of say 6 years, practically speaking, your downside of 15% in gold is basically arrested because of the 2.5% interest what you are getting on the sovereign gold bond. So it's quite a unique feature. The reason why you are getting this interest is government definitely wants to reduce the import of gold and investment demand, to curtail the investment demand from the physical gold to this kind of instrument is really healthy for our fiscal balance, trade balance. Deficit is going to be aided by that. So the intention is that so far we have not seen any meaningful downward growth in India's gold import, because the jewelry demand itself remains pretty strong as the economy is going from 3 trillion to 4 trillion, $4 to $5 trillion. The aspiration and the income level of people are increasing. The spending is increasing. So the demand of gold is not going to abate. And that's the reason they will not be able to, they are not getting the desired result. But the fact is the investment demand is surely getting a lot of momentum in this form of investment. And because of, no matter how many people are buying, instead of physical gold, if they are buying sovereign gold bond, it is absolutely positive for retail investors. I remember the first tranche when it came, the price of that was almost, if I'm not wrong, 2,900, 2,800. Today they are launching a tranche which is 6,200 rupees, if I'm not wrong. So 6,200 rupees is from 2,800 rupees if you would have invested 7 years back when the first tranche came. Today it is the same tranche is 6,200, and all year, every year you have received 2.5% interest.
Okay.
So just imagine the kind of wealth people have made in gold. So I'm
All
not
right.
saying that gold prices are going to be 1,30,000, but even from here, conservatively 10 to 12% of return your sovereign gold every year is going to give you.
Absolutely, 2.5% return. Imagine the wealth it would have created. That is of course a good way to kick this off. But should you buy, depending on your appetite? We are discussing sovereign gold bonds series 4, and should you buy as an investor? What are the profits that you are likely to make if you buy a tranche of sovereign gold bond? Remember, this is the fresh issue in this year, and Kunal Shah is with us. He continues to be with us. Kunal, I think before we let you go, a big question that is going to weigh in on every person's mind, and that is, at a time like these where you mentioned that gold prices are exorbitant, they are touching sky high, does it make sense for an investor to buy gold if they have, let's say, an overview of next 2 to 4 years as opposed to 5 to 8 years, when they're perhaps likely to get some similar sort of returns as they did about 7 years ago? Should it be used as a hedge, or should it be used as an investment vehicle and as investment tool at this point?
Okay, so first of all, gold is a strategic investment in today's time. So forget about the price right now. Let us not discuss where gold prices are heading. But few key things to remember at a times when the central bank's balance sheet have expanded to unimaginable level, especially of the Western central banks, at a time when the geopolitical concerns are every year making some of the other headlines in some of the other parts of the world. Who would have imagined 1 year back that Israel and Hamas, we had a serious crisis in the Middle East? No one would have. We were talking about Russia and Ukraine. Suddenly, Israel and entire Middle East, what you are seeing right now. So this is number 2 reason. Number 3 is the road ahead for the central banks. So it's very dicey and very choppy. Nobody knows what is going to happen going forward. Whether the central banks are going to be very aggressive in cutting the rates. If they do so, the inflation will shoot up. If inflation shoots up, again they have to cut down the interest rate and bring down the inflation. So till how long this all thing, how long this will go on? So considering all of these equations, the monetary base of all the central banks, Western central banks, have been really fractured and damaged to an extent that if something go wrong in the financial market, what is your protection? What is your safety? And that's the role of gold. So I don't see the problems which have been created post-COVID, especially of central banks. I don't think so. There is any easy answer to that. There is a de-dollarization going on. Central banks themselves are buying gold. So out of 4,000, so you see last year, central banks bought almost 1,000 tons. A year back, they bought 1,150 tons. If you see the 10 years average, they have not been buying even 400 tons of gold. The same central banks are buying gold. They are not buying US treasuries. They are not buying Europe's treasuries. They are not buying Japanese bonds. They are just buying gold. So
Okay.
nobody is buying each other's bonds. They all are investing in gold. So the possibility of gold crashing down, there are going to be bout of correction, but will gold prices go to $1,500? The answer is no. So the next 4 5 years, there is going to be a gradual uptick in gold prices, and in unpredictable event or unprecedented scenario, it can really shoot up and give you the alpha. So that's the reason why you should invest in sovereign gold bond, not with the intention that in next 4 years gold will be 1,30,000. No, gold is not. If it happens, it's another story. But my base case scenario is that you are going to get 10 to 12% return conservatively on gold, and apart from that, another 2.5% return will be you are getting through sovereign gold bond interest income. So if you are getting 12-14% return, it's a good return in today's world. So
Absolutely.
that's the reason why you should invest in gold.
Okay, just to follow up on that discussion we're having with Shweta, traditionally speaking, say the domestic price of gold index, if you were to track it in the recent past, for the rate of return for gold is around 8.9% over 1 year period, 9.5% over a 3 year period, and 13.54% over a 5 year period. Do you expect the same numbers to continue then in that sense? 8.9 for a 1 year period, 9.5 for a 3 year period, and 13.5 for a 5 year period?
Well, for next 3 to 4 years, it can be the same number or higher than that.
Okay.
It has a potential to give the same amount of return or higher than that, but not lower than that.
All right, so I think that's the word coming in from Kunal Shah. Gold prices only will be inching up from here, not likely to go down. The returns perhaps will remain either similar or higher, not lower than what we have seen in the past. Kunal Shah, always a pleasure, sir. Thank you very much for joining in, for sharing your inputs on that very crucial story.